Hello, everyone. This is Zach Gardezy. I'm the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a private wealth advisor and a certified financial planner. So I wanted to make a video this week to address what's happening in the market. I've been getting a lot of great questions from clients, and I thought it would be very helpful to put a video together that addresses five major topics. So where are we? Why we're here? What's causing the market downturn, basically? What may happen next? Which is based on my overall outlook, how Wealthstone clients are positioned, and then the do's and don'ts of what to do during a market downturn. So this video, I hope that you find is helpful and helps you understand based on facts and unbiased data as to what's going on right now, and then what I think investors should do, or at least I'm sharing with Wealthstone clients during times like these. So let's get right into it. So where are we now? The S&P 500, which represents the 500 largest publicly traded companies in the United States, has entered into a correction. Now, I just want to correct that statement because today is March 14th, Friday, and the market actually went up 2%. So we're technically out of a correction now, but we're still in correction territory, which basically just means that, for example, Monday, the market could go down 2% or more, and now we're back into a correction. Nonetheless, whenever the market goes down 10% or more and enters into a correction, typically gives investors a sense of pause. What's going on? Why is the market correcting? Now, I want to back this up with some statistics. Corrections, they're actually not that rare. They're pretty common, frankly. They occur about every 1.6 years. And so there are years even where you could have multiple corrections in any given year. So it happens, it's quite normal. And the average time of recovery from a correction is about 4 months. And so, again, we're in correction. We, based on today's market returns, technically got out of our correction, but I wouldn't say that we're necessarily out of the woods yet. Market volatility is quite high. And so investors should remain cautious, but understand what it exactly means when we talk about the market and being in a correction, and then the frequency of corrections as well. Now, you're probably wondering, well, why are we here? Why are we in correction territory or in and out of a correction? Now, I really chalk this down to four major themes. Number one, it has to do with trade policies and tariffs, right? So we're basically in a trade war with China, with Canada, with Mexico, the European Union. The new administration has aggressively began their tariff policies. And although the optimists believe that these tariffs are going to lead to deals and get us out of tariffs, and they're more of a negotiation tactic, it has caused uncertainty in the markets. And that's really the overall theme of what's causing all this. It's uncertainty, frankly. But we want to get more specific on today's video and talk about what exactly is causing that uncertainty. So, number one, trade policies. Number two, geopolitical tensions. So we're now in the midst of potentially the end of the Ukraine-Russia war, but every day as this war, the negotiations either improve or, for example, what happened in the Oval Office with President Zelensky and Trump, if the odds of the deal falling through increase, now you can have the market reacting negatively to this. So you're going to see this as part of the whole volatility structure is what's happening from a geopolitical perspective. And it's not just in Ukraine. There are other conflicts around the world. There are other situations arising every day, basically, that can cause the markets to have a positive or negative reaction. But nonetheless, the eyes are on what's happening in Ukraine and Russia right now, and that is going to have significant effects on the global economy and even with inflation, as I'll talk about a little bit later. So that's topic number two as to what's causing the market to have a downturn. Number three has to do with inflation and the Federal Reserve. The Federal Reserve has been concerned about the new administration and what their policies are going to do with inflation. So as we saw with January's inflation reports, inflation's actually started to increase. As we just received the February CPI report, to a surprise for all, inflation was actually lower than expected. This has caused a lot of positivity and optimism with the fight for inflation and bringing it back down to normal levels. But nonetheless, the Federal Reserve, despite this positive report, remains concerned about inflation going higher as some of these new trade policies are enacted. And this has reverberations into interest rates, which then affect all other parts of the economy and the overall market. So that is point number three. And then point number four for what's causing the market downturn has to do with artificial intelligence and the overall competitive nature of the industry. As we saw earlier this year with the launch of DeepSeek AI, which has now caused a lot of investors to take a step back and wonder, can artificial intelligence be developed at a cheaper cost? And what does this mean for companies like NVIDIA who sell very expensive hardware? Is the demand really going to continue if AI is becoming significantly more efficient? And so those are really the four major themes that I believe are causing the market to have entered into correction and into correction territory. Uh, and I'll talk about as well what may happen next. But it's very important to understand, why we are where we are today. So what could happen next? I want to share my outlook on a lot of these topics that are really causing the market to enter into a correction. So number one, as it relates to trade tensions and trade policy overall, let's start with what is the intent of the Trump administration with putting these tariffs in place, whether you agree with the administration or not. In my opinion, the intent is not to generate significant tax revenue for a long period of time from these other countries. I believe it really just has to do with the fact that the Trump administration just wants some sort of new deals put in place with these countries to balance out trade deficits or to form some sort of other arrangements. Now, whether or not those deals are reached, how long they take, the impacts it'll have on underlying economies, that's what brings uncertainty into the market. And that's what's causing higher volatility. And that's what's causing the market to react negatively. The one thing investors don't like is uncertainty. And so that is a key reason why the market's doing so poorly as it relates to trade policies. But I do believe that whether it's with Canada and Mexico or even the European Union, I do believe we'll reach deals with these countries and regions, and the market will react positively once those deals are reached. But in the meantime, we're going to see continued volatility every time there's a new headline put out about increased tariffs or reciprocity from other countries, tariffs against us, and basically what's known as a trade war. That will, of course, bring negative headlines and effects to the overall market. But I have a rather optimistic view that deals will be reached, and we will lead to a positive effect on the market as those events happen. Now, something to keep in mind, during the first Trump administration, there were significant use of tariffs. And even during the Biden presidency, there were continued tariffs in place against China, for example. Under the first Trump administration, inflation averaged about 1.9%, even with tariffs against China, Canada, and the EU on a lot of similar goods that we have tariffs against now. So inflation is not always a byproduct of tariffs. There are certain products and certain elements of it, certainly that are correlated to each other, but we have to look at it at a more deeper level. So I was listening to an economist that I respect a lot who shared this viewpoint that I'd love to share with you as well, which is not every product has a good substitute. Or, for example, maybe the market is just so competitive in a certain sector or certain product space that if that company is subject to tariffs, if they were to raise their prices, they would be completely out of the market. So it actually makes sense for that company to pay the tariff and stay in the market and just take in less profits and deal with that aspect of it. So I don't want to run with the notion that tariffs equal inflation 100% of the time. That's just not the case. We even have evidence of that during the first Trump administration. Now, this new administration, right, is being a lot more aggressive with tariffs, and that is what's causing a lot of panic. But I do want to play the wait and see approach here to see, well, what exactly is going to be affected? What are the effects? And let's be more analytical with our reaction. And I think a lot of investors are having a knee-jerk reaction to tariffs and headlines, which I don't blame them. That's the purpose of this video. Conventional media really likes to play the fear game and just scare you and think, oh, yeah, these tariffs are going to lead to hyperinflation and everything's going to crash and the banks are all going to fail. And, everybody just go, stash a bunch of cash under your mattress. There's a lot more in play here, frankly, and there's a lot more of an analysis that we have to do to figure out, well, what exactly is going to happen with tariffs. But nonetheless, before we even get to that point, I do think that we'll eventually reach deals, whether they'll be good deals or bad deals or literally the same exact deal just with a new name. I'm not exactly sure, but I don't think that these tariffs are going to last for too long. I think that the Canada and Mexico tariffs, if they even ever get fully put in place, are going to be short-lived, and similarly with the European Union. So um, that's one aspect of what's happening and what's causing the market to be into correction, and that's my outlook as it relates to trade policies. The next is as it relates to geopolitical conflict. So as we've talked about earlier with the Ukraine-Russia war, I do think that that war is going to end. The Ukrainians have already agreed to a ceasefire. We're waiting on the Russians now to agree, and it seems like they have their own set of demands, which makes sense. And so we'll see what the negotiations and how they unfold. But I do think that we're near the end of this conflict. Now, this is a really big deal because one of the things that I mentioned earlier is the Federal Reserve is very concerned about inflation. And as they're concerned about inflation, the odds of rate cuts have certainly decreased. And this has caused capital markets to have a very negative reaction, right? And so, well, something that's not being talked about a lot is, well, what are the inflationary effects of the war with Ukraine and Russia? And if the war were to end, Russia re-enters the global economy, which is something Senator Marco Rubio talked as part of their negotiation tactic for getting Russia to end the war. What will this do to inflation globally and certainly in the United States? Well, two important things are something that we should pay attention to. One is Ukraine has been one of the largest grain exporters in the world, and they still have not returned to their pre-war levels of grain exports. Now, there's a couple of reasons for that. Number one, obviously, there is a war going on, and one of their key shipping routes through the Black Sea has been basically shut off by the Russians. And so, um, because of that, the Ukrainians had to start selling more grain into Europe, which then caused a whole host of other issues, which is point number two here about the grain problem. European countries have put certain bans and export controls against Ukraine because Ukrainian grain exports were causing significant problems in European countries and their food prices being basically depressed by all of these new exports coming from Ukraine. So to really wrap that in a bow here, when the war ends and Ukrainian grain shipments are going to go back to their pre-war levels, you should see food prices globally start to come down, which is a good thing for bringing down inflation. Secondly, Russia remains one of the top oil producing countries in the world. But as I mentioned, whether it's as it relates to sanctions or just export controls, it has been difficult for Russia, nearly impossible, frankly, to get back to selling oil to Western countries as they were doing so before the war. But as Marco Rubio shared, they do want Russia to re-enter the global economy. That means more oil being pumped out and sold around the world, which should lead to lower oil prices. Now, it's possible that Russia, OPEC, and the whole group do a much better job of handling this and actually keep oil prices relatively stable. But as an optimist, you want to maybe consider the fact that, well, if the war ends and we get back to Russia selling oil around the world and other energy sources, then this should lead to lower energy prices. Now, you may be wondering, for those who pay attention to core versus headline inflation, remember headline inflation includes everything. It's food and energy prices. Core inflation excludes food and energy. Now, the Federal Reserve's viewpoint on this is, well, we want to exclude food and energy because they don't necessarily uh, paint a trend picture, right? Like food prices, something could happen around the world. This could cause food prices to go up or down. Something could happen with oil prices. A good example that I usually give is, if the king of Saudi Arabia wakes up in a bad mood and decides to restrict oil exports, this can cause oil prices to all of a sudden shoot up. And is that really a good way to project where long-term inflation is going? So I get that point from the Federal Reserve and why they look at it that way. But us regular everyday people, we are every day affected by food and energy prices. And whether you look at headline or core, it doesn't really matter. Food and energy prices do trickle their way, even indirectly, into core inflation as well. Whether it's the cost of getting things to other places, which is an energy issue, whether it's the cost of feeding workers and having to pay workers more money, which then affects wage inflation. There's just food and energy, whether you exclude it or include it, doesn't matter. It's part of inflation. So as the war ends in Ukraine, and you see food and energy prices come down, this should be a good thing for overall inflation and bringing it back down to the Fed's 2% level. That's a good thing for the market, not only because inflation would come down, but also because this may invigorate the Fed to consider doing more rate cuts if inflation does fall faster than expected. Um, Point number three, as it relates to artificial intelligence and technological advancements overall, as it relates to my outlook, look, DeepSeek AI came out. It caused a lot of concerns in artificial intelligence, notably with NVIDIA and others, as it relates to expensive hardware and whether or not the demand is really needed. Now, my thoughts on this are, look, DeepSeek AI, yes, it was made relatively cheaply, but already with the increased number of users they have, they had to increase their prices. And frankly, when it comes to things like AI or any sort of advanced technology, we're still at the early stages of this. And so we're going to need more advanced hardware, more advanced software and products. And so I don't think that we're at a point now where we can say, you know what, NVIDIA, step aside. You're not needed as much as you were before just because of a one company out of China who made an AI that's relatively cheap, right? OpenAI, Anthropic. There's so many other companies out there. XAI with Elon Musk that's coming out and making great products. The advancement is still happening, and I believe the demand is going to actually increase because we're nowhere near, I think, the peak of artificial intelligence, and so that should be a good thing for the markets as the S&P 500, to be more specific, is still significantly weighted into mega caps and to technology. So um, the overall outlook is frankly the market is concerned about all the uncertainty that's happening right now, but there is a more astute way to look at what's happening and understand that look, when a lot of things happen at once, the market is just having to absorb all this negative information. And some of the more positive things, as we look forward towards the year, could actually cause the market to recover. And I think still end the year in a positive way. Something that I did not cover yet, which is a bit off topic, but there is tax legislation that we should look forward to, which is potentially lowering tax rates for Americans and other corporations and potentially even deregulation elements as well, which is typically a boost for the markets. And so still more to be seen as far as what exactly is happening. Those are negotiations going on right now in Congress, but nonetheless, those are also positive things that could impact the market. So in the first few months of the Trump presidency, there's just a lot happening. As I've talked about in other videos, it's to be expected. The first year, frankly, of any presidency, there's a lot going on. The first 100 days, every president wants to make as much noise as they possibly can and let the world know that they're here. Well, that's certainly the case right now with the new administration. And so, as investors, we'll talk about later the do's and don'ts and how to navigate this. But that's my overall outlook as to what's going on. I still maintain a cautiously optimistic view of how the year will play out. So I do get a lot of questions, and this is really comes a lot from non-Wealthstone clients or even other professionals who are just curious, how are we positioned right now during times like this? And so I'll break this down into two different categories. You've got clients who are eligible to invest in alternative investments. I'll talk about what that is in a moment. And then clients who are not eligible based on laws and regulations. So we understand stocks and bonds and what those are. Alternative investments is a third asset class where basically those are investments that are just not stocks and bonds. This could be private equity, private real estate. This could be private credit, hedge funds, even Bitcoin, for example, could be considered an alternative investment, and other commodities. And there's so many different things that could be considered alternatives to buying your traditional stocks and bonds. And as an investment manager, I want to include alternative investments in a portfolio because they typically have low correlations to the other assets, stocks and bonds. And so correlation, which is another word we commonly use in the investment industry, correlation basically is just the connection or the relationship between one investment and another. I'll give you a great example of that. Bank of America stock and JP Morgan stock are highly correlated to each other because they're both financial institutions. And if, for example, something happens in the economy or the financial sector that causes Bank of America stock to go down, pretty sure bet that also JP Morgan stock will go down as well. It's not always the case. Sometimes there's idiosyncratic situations that come up, which are more related to the individual company. Like, for example, something happens to the CEO of one of these companies that can cause that one company to go down. Well, maybe others aren't negatively affected by this. And so Um, I look at correlation, but when I'm building a portfolio, I build it using stocks, bonds, and alternative investments for clients who are qualified to do so. Now, there are clients who are not qualified. In order to invest in alternative investments, you typically need to be an accredited investor, which means you must have at least a net worth of $1 million, which excludes real estate. And there is an income component of it as well for single or married investors. And so, as long as you're an accredited investor, you most likely have or have heard of alternative investments in your portfolio. But if you haven't, that's something that I would at least consider discussing with your financial advisor. Now, for clients who are not accredited investors, and then also to discuss the other investments in the portfolios, even for accredited clients, which are the stocks and bonds portion, I focused on US based stocks in the large cap space, and then in the bond sector, focusing on investment grade, high quality bonds. And so I believe that during times like these, and the statistics show this, you want to be invested in high quality investments. This is not a time where you want to be taking significant bets or investing in speculative asset classes. You want to be invested in high quality names because even in some of the worst downturns that we've ever seen, the high quality large cap, mega cap companies have weathered these storms. They have significant cash on the books. They've been through stuff like this before. They should come out and come through any sort of negative downturn in the markets. Whereas some small, micro company that just recently over the last few years has IPO'd, they probably haven't gone through something like this before. Or maybe they don't have the financial stability to go through something like a sharp downturn or manage significant tariffs or trade wars. And so as an investment manager, investing significant assets for clients, I want to invest in high quality investments during times like these. And in the alternative investment space, I like private equity, I like private real estate, and I like private credit. And then in some cases, I also like hedge funds as well. And so for a lot of Wealthstone clients, we are already positioned in these investments. And as new opportunities come up, I've been bringing them to the forefront for clients. And for clients who do not have uh, their investments already over on Wealthstone, or maybe we're in the transition period, it's a lot has to do with rebalancing portfolios because what you also don't want to have right now is to be way off in terms of what your risk levels are in your portfolio. You do not want to be significantly risky if maybe you're someone who's just a few years away from retirement or already retired. And so it's very important to pay attention to what your overall financial plan is, pay attention to what your risk tolerance is, but then also manage the portfolio in a way that aligns with you and your life. And so if you're someone who is okay with taking on significant risk, maybe you've got a very long investment time horizon, you don't need access to the capital. Okay, maybe there's a lot of great opportunities right now to take on risk and buy some stocks that are significantly discounted based on some of the pullbacks that we're seeing. But if you're a retired investor living on a fixed income and this portfolio is really what you need to survive for the rest of your life, this is not a time to start looking for, fancy new investments that could give you significant returns. This is just not one of those times where you want to take on those kinds of bets. And so that's the overall, what we're doing from a positioning standpoint at Wealthstone for existing clients, accredited, non accredited, and then also what discussions I'm having with clients who have not yet moved over assets. And one more point, real quick, on this topic is concentrated stocks. So a lot of clients that I talk to or prospective clients work for publicly traded companies who have concentrated stock positions. Basically, what this means is, you've received so much company stock throughout your career that now a large part of your overall net worth is comprised of your company stock. Maybe you're still working there, so your income is tied to it. Maybe you live in the local vicinity, so even your real estate market could be tied to it, and your net worth is tied to it as well. So this is a great example of a time where investors should look for ways to diversify their concentrated stock positions. And that doesn't mean you have to sell it and pay your taxes. There are ways to diversify, whether it's through the use of exchange funds or option strategies. There are ways to diversify your positions without having to pay huge tax bills. And so it's important to talk to a financial advisor who has experience in this area because you don't need to go through significant volatile periods like this with very large concentrated stock positions. So for the last part of today's video, I want to focus on the do's and don'ts of what to do during a market correction or really any major market downturn. So this is what you'd want to do during times like these. You want to stay invested You want to diversify your portfolio if you haven't done so, and you want to focus on quality investments. But what you want to avoid doing is panic selling, attempting to time the market, and neglecting rebalancing your portfolio. And a chart that I'll put up on the screen really helps drive the point home here. And that is the chart of the performance of the S&P 500 from January 1st, 2003 to December 30th, 2022. And what this chart will show you is that those investors who stayed fully invested during this period of time, and remember, this is what happened during this period of time. We had the great financial crisis. We had 2018, where the Federal Reserve raised interest rates and caused the markets to have a very negative reaction. You also had the COVID pandemic, which caused the market to crash. And then you also had significant inflation during this period as well. Those who stayed fully invested during this time averaged a 9.8% return. But those who missed the 10 best days in the market, let's just say it's somebody who pulled out of the market or took a significant chunk of their portfolio out, went to cash, and said, you know what? I'm going to try and figure out the best time to get back in. Well, the hard part of doing that is trying to figure out where the bottom is and then when you should get back in. That's nearly impossible to do that. Those investors averaged a 5.6% return. So a very sharp difference between those who just really did nothing and just stayed invested during that entire period of time. And as those investors missed more and more of the best days of the market, you see the performance drop even further in their portfolios. And so this drives the point home of just don't try and time the market, don't panic sell. The best thing to do for most investors is to just stay invested and ride this thing out. Now, I say that for clients who are already fully invested in diversified, high quality portfolios. For those of you who are either holding significant cash positions, maybe you're in concentrated stock positions, or maybe you're in a portfolio that you're not so sure is high quality, it's very important to talk with a financial advisor. Reach out to me, reach out to somebody you know who's in this space to help you professionally analyze your portfolio to figure out if you are where you should be in terms of your goals, your overall wealth, and just what would be the best thing to do for your investment portfolio. Because although the market is down sharply, it's not too late to try and make adjustments to your portfolio to just be more aligned with what's happening in the world as we've discussed today. And so hopefully this video helps you understand, where we are, what's causing the market to go down, what my overall outlook is, and then really share with you some tips and some do's and don'ts as far as what investors should do during times like these. But thank you so much for tuning in. As always, if you have any questions, please don't hesitate to reach out. Thank you very much.